Welcome to Talk Tickers. So today we are doing a deep dive into an earnings call that is, well, it's just bizarre.
It really is. It's fascinating.
Right. I mean, we are translating Wall Street jargon into actionable insights for retail investors like we always do. But today we are looking at Honda's Q1 2027 earnings.
And this one is a roller coaster.
Exactly, because, imagine a company posting its absolute highest record-breaking profit in its entire history, like ever.
Yeah, they are literally swimming in cash right now.
Swimming in it.
Yeah.
They have 3.3 trillion yen just sitting on the balance sheet.
Which is a staggering number.
But then simultaneously, behind closed doors, they're basically being forced to pay over 500 billion yen in penalties.
Right, just because they bet on the wrong future and, well, they have to tear up their own contracts.
It is such a contradictory reality happening inside Honda. Reading through this Q1 transcript, it's like watching a race car driver setting all-time lap records,
Oh, yeah, the crowd is going wild.
Exactly. But then you look closer and the pit crew is like literally sprinting alongside the vehicle, trying to swap out the gas engine for a battery pack mid-race.
That is a perfect analogy. It's an incredibly precarious balancing act.
So that's our mission today. We are going to tear this earnings report apart line by line. We'll start with the headline numbers, then the story behind them, management's guidance, and finally the bottom line.
Right, because if you are holding Honda, or really any legacy auto stock right now, you absolutely need to understand the mechanics of what happened this quarter.
Let's just jump right into the sheer scale of the profit. So operating profit for the first quarter came in at JPY 530.7 billion.
Yeah, and to really contextualize that figure, JPY 530.7 billion is the highest first quarter operating profit Honda has ever recorded in its history.
Wow.
It is an increase of JPY 286.5 billion year over year.
Wait, so they basically doubled it?
They more than doubled their operating profit compared to the exact same 3-month window last year.
That's insane for a legacy automaker, right?
Oh, totally. I mean, for a manufacturing behemoth with massive fixed costs and, established global supply chains, doubling operating profit is highly unusual.
Right.
It really points to this unique confluence of macroeconomic tailwinds and very localized product demand.
Well, I want to break down where that cash actually originated, because I think it's heavily weighted toward a segment that a lot of North American investors just completely overlook.
You're talking about the motorcycles.
Exactly. Motorcycle operating profit hit an all-time quarterly high of JPY 233.9 billion. We always think of Honda as the company that makes like the Civic or the CR-V.
Okay, the car company.
Yeah, but the margin profile on their two-wheel business is what actually fortifies the entire balance sheet.
It really does, because the economics of manufacturing a motorcycle versus a four-door sedan are just vastly different.
Right, tell us about that.
Well, with a motorcycle, and we're particularly talking about the low-displacement scooters and commuter bikes that Honda sells tens of millions of in emerging markets, you have incredibly low material costs.
Makes sense. Less steel, less everything.
Exactly. And minimal complex software integration compared to a modern car. Plus, you get massive volume leverage.
What does that mean practically?
So when you were producing like 5 or 6 million units a quarter, the fixed costs of your stamping facilities and engine plants are absorbed so efficiently.
Oh, right. So the gross margin per unit just expands beautifully.
Exactly. This is why the motorcycle segment acts as the reliable cash engine for the broader corporation. They just print cash on those.
Okay, so then when we pivot to the four-wheel business, the automobile operating profit came in at JPY 192.1 billion. And the metric that stands out to me there is the 5.0% operating margin.
Which is very strong.
Right. Because in the global automotive market, legacy players are often fighting just to break 2% or 3%.
Oh, absolutely. They carry heavy pension and union liabilities.
Yeah, so 5% means they are actually generating real sustainable cash on the metal they move off the dealer lots.
It really does. A 5% operating margin on automobiles indicates that they are operating their assembly plants at near optimal utilization rates.
Right. The factories are humming.
Yeah, in automotive manufacturing, capacity utilization's at everything. If you have a plant designed to build, say, 300,000 cars a year, but it only builds 200,000.
And the depreciation and overhead costs per vehicle just crush your margins.
Exactly. And Honda has managed to align their production closely with localized demand, which minimizes the need to idle plants. And that protects that 5% margin.
Plus, we have the financial services division, right? They added JPY 105.8 billion.
Right, just capturing the interest payments on the loans and leases of those vehicles.
So you have a very robust traditional business model functioning at peak efficiency. Oh, and Power Products took a slight operating loss of JPY 1.1 billion,
But against a JPY 530 billion quarter, that is basically statistically irrelevant.
Totally. So all of this operational cash generation leads us to the balance sheet. As of June 30, Honda is sitting on JPY 3.33 trillion in net cash within their non-financial services business.
They are heavily fortified, to put it mildly.
Yeah. But here is where we have to stop reading the press release and start interrogating the accounting a bit.
This is the important part.
Right, because throughout the call, management continuously emphasized their adjusted operating profit guidance. They pegged it at JPY 1.17 trillion for the full year.
Right.
But they arrive at this massive number by explicitly pulling out all the expected losses related to their electric vehicle transition.
Yeah, and the distinction between standard GAAP operating profit and adjusted operating profit is probably the most critical debate in this entire earnings report.
So translate that jargon for us. Standard versus adjusted.
So standard operating profit measures every yen that came in minus every yen that went out related to running the business. Simple enough.
Right.
But management teams use adjusted metrics to tell a specific narrative. By excluding the EV transition costs, Honda's management is making an argument.
What's the argument?
They're arguing that the EV losses are an isolated, one-time structural recalibration of their strategy.
Ah, right. Rather than a reflection of their ongoing daily operations.
Exactly. They want investors to look at that JPY 1.17 trillion and just see the underlying health of the internal combustion and hybrid business.
Okay, I'm going to push back incredibly hard on management's logic there.
I don't blame you.
You cannot simply draw a box around your most expensive, existentially necessary business initiative, label it transitional, and ask Wall Street to ignore it.
Right, because it's not going away.
Exactly.
Yeah.
Electric vehicles are not some side project or a temporary headwind. They are the required future of the entire automotive sector.
I completely agree.
So excluding hundreds of billions of yen in EV losses from your adjusted profit is like bordering on accounting fiction. Cash leaving the building to pay suppliers for canceled EV contracts is still cash leaving the building.
Yeah, and it directly impacts free cash flow and the capital available for share buybacks or dividends. Your skepticism is entirely warranted.
Thank you. It just feels so misleading.
Well, the argument against Honda's adjusted metric is that the transition to EVs is going to take a decade or more. It is not a one-off restructuring charge.
Like closing a single factory.
Right. It is a perpetual state of operations for the foreseeable future. However, from a purely analytical standpoint, looking at the adjusted operating profit does allow us to isolate the performance of the legacy ICE business.
ICE being internal combustion engine?
Correct. If you are trying to model how much cash Honda's traditional assets can generate to fund the EV pivot, the adjusted number gives you that baseline run rate.
Okay, I see that. It shows the strength of the old machine paying for the new machine.
Exactly. But you are absolutely correct that valuing the company solely on that adjusted number just completely ignores the very real, very expensive reality of the current market.
Let's dig deeper into the reality of that legacy business then, because we see this record, JPY 530.7 billion profit. But when I read through the specific ledger breakdown from Sumihiro Takahashi, he's the operating executive, I noticed a massive red flag.
The unit sales volume.
Yes. The actual unit sales of automobiles went down. They only sold 786,000 units. If volume is down, how is profit doubling?
It's a great question.
Are these record numbers actually proof of a brilliant corporate strategy, or is this just an artificial bump from currency exchange rates?
The data in Takahashi's breakdown provides the exact mechanism behind this. Let's look at the bridge from last year's profit to this year's. The impact of actual sales volume and product mix was actually a negative JPY 6.1 billion.
Wait, a negative impact?
Yes.
That is wild. So despite selling more motorcycles globally, the combined impact of what they actually sold hurt their profit compared to last year.
Exactly. And the primary culprit here is the mechanism of sales incentives. In the automobile business alone, the sales impact was a negative JPY 38.6 billion due to incremental sales incentives.
Okay, let's explain how sales incentives work mechanistically for the listener, because this isn't just Honda putting a sales sign on a windshield, right?
No, not at all. Sales incentives, which are often called cash on the hood in the industry, happen when an automaker has to subsidize the purchase of a vehicle to move it off the dealer's lot.
Right, to grease the wheels.
Exactly. This happens when supply outstrips demand, or when interest rates are so high that consumers just cannot afford the monthly payments on a standard loan.
And we are definitely in a high interest rate environment right now.
Oh, absolutely.
Yeah.
So to prevent inventory from piling up, because if it piles up, dealers have to pay exorbitant floor plan financing costs. Honda steps in.
What do?
They offer subvented leases, 0% APR financing deals, or direct cash rebates. So that negative JPY 38.6 billion means Honda had to spend significantly more this quarter to bribe consumers to buy their cars than they did last year.
Wow, which means the core organic demand for their overall product lineup is actually softening.
Right, requiring them to compress their own margins to maintain volume.
Okay, so if the organic business of selling cars is actually generating less profit, where on earth did the JPY 286.5 billion increase come from?
Look at the very bottom of Kakahashi's ledger. The foreign currency impact was a positive JPY 90.8 billion.
Holy cow.
And the tariff impact was a positive JPY 78.1 billion. Out of the total increase in profit, nearly JPY 169 billion came entirely from a weak Japanese yen and favorable tariff conditions.
That is the definition of a currency mirage. The the sole reason they are hitting all-time record highs is an accounting tailwind driven by macroeconomic factors completely outside of Honda's direct control.
It is entirely macro-driven.
Let's break down the mechanics of the yen impact. Why does a weak yen suddenly inject JPY 90 billion into Honda's operating profit?
It comes down to how global revenues are repatriated and reported. Honda sells a massive volume of vehicles in the United States, meaning they collect billions of US dollars in revenue.
Right, people buy cars in dollars here.
But because Honda is a Japanese corporation, they must report their consolidated earnings in Japanese yen. When the value of the yen depreciates relative to the dollar meaning, it takes more yen to equal $1. The U.S. revenues translate into a significantly higher number of yen on the income statement.
I get it. So if you sell a CRV for $30,000 in America and the exchange rate is 130 yen to the dollar, that's about 3.9 million yen in revenue.
Right.
But if the yen weakens to 155 to the dollar, that exact same $30,000 car instantly becomes 4.65 million yen on Honda's books.
Precisely. They didn't sell another car, they didn't raise the price, they didn't make the factory more efficient.
The Bank of Japan just kept interest rates low while the U.S. Federal Reserve kept rates high. The currency market reacted, and Honda magically prints an extra 90 billion yen in profit.
Exactly. And this is why relying on this profit as a signal of long-term business strength is dangerous.
Because currency markets are notoriously volatile.
Exactly. If the Bank of Japan decides to aggressively hike interest rates to combat domestic inflation, or if the U.S. Federal Reserve cuts rates rapidly, the yen will strengthen.
And if that happens, Honda's record profits will evaporate just as quickly as they appeared.
Yep, exposing the underlying weakness in their volume and incentive spending.
That brings us perfectly to the actual geographic and product mix. We know the headline profit is inflated by currency, but there are areas of genuine operational strength, right? Specifically in North America.
Oh, definitely.
CFO Masao Kawaguchi was very blunt about the consumer psychology right now. Gas prices remain elevated, and American consumers are feeling the pinch at the pump. But they are still wary of fully electric vehicles, so they're flocking to low fuel consumption hybrids.
The hybrid strategy is currently the strongest pillar of Honda's global automotive business, without a doubt.
Yeah, and for years, pure-play EV advocates criticized Honda and Toyota for lagging behind in battery electric vehicles, right? Arguing they were clinging to obsolete internal combustion technology.
Yeah, they took a lot of heat for that. But the current market reality has completely vindicated their caution.
How so?
Well, widespread consumer anxiety over EV charging infrastructure, combined with the higher upfront cost of EVs in a high interest rate environment, has created a massive demand bottleneck for pure EVs.
People just aren't ready to take the plunge.
Exactly. So hybrids offer the perfect bridge. They alleviate range anxiety, they do not require home charging installations, and they immediately lower the consumer's monthly fuel expenditure.
And Honda has the engineering pedigree to really capitalize on this. Their EHEV hybrid system is incredibly efficient and drives very much like a traditional car, which appeals to the mass market.
And the market share numbers from the transcript prove how effective this strategy is.
Oh yeah, let's talk about that. In the United States, Honda captured a 10% market share across April and May.
Which is huge.
It's their highest market share level in the US in 5 years. They're actively stealing buyers from competitors who over-indexed on pure EVs and just don't have enough hybrid inventory to meet current demand.
It is a textbook example of having the right product at exactly the right macroeconomic moment. Even their traditional internal combustion vehicles are benefiting from a halo effect here.
Right, because their baseline fuel economy across the fleet is generally superior to the domestic U.S. automakers anyway.
Exactly.
But while America is carrying the four-wheel business, we really have to look at where the volume really lives, the motorcycle segment.
Oh, the volume is staggering.
They moved 5.66 million units in a single quarter. Just to understand the scale of that, Honda builds and sells more motorcycles in a week than some boutique automakers sell in a decade. Where is all this volume going?
The massive drivers here are India and Brazil.
Let's start with India.
In India, the market dynamics are fascinating right now. The Indian government previously implemented goods and services tax, or GST, cuts that favorably impacted the two-wheeler segment.
Let's explain the mechanism of the GST in India for a second, because it drastically alters consumer behavior, right?
It really does.
India's tax structure is heavily tiered. So by lowering the GST bracket for certain classes of motorcycles or scooters, the final on-road price drops significantly.
Right, and in a highly price-sensitive market like India, where a scooter is often a family's primary mode of transportation.
And a critical tool for economic mobility.
Exactly. A 5% drop in the tax rate can suddenly unlock millions of potential buyers who were previously priced out.
Wow, so it's a huge policy tailwind.
It is. The elasticity of demand in the Indian two-wheeler market is extreme. The momentum from those policy changes is still cascading through the economy, driving massive, sustained demand.
I noticed management explicitly noted during the call that they need to increase production capacity in India because current demand is drastically outstripping supply.
Yeah, a great problem to have. And then you also have Brazil, where management pointed to a stabilization of the overall economy.
Right. When inflation cools and lending rates stabilize in an emerging market, consumer credit expands, allowing more people to finance the purchase of a motorcycle. And what about their home turf? We generally assume the Japanese domestic market is super saturated, but domestic sales were actually surprisingly strong.
They were. The overall Japanese auto market grew about 107% year over year.
Oh, wow.
Yeah, mostly due to the easing of lingering supply chain constraints that hampered production last year. However, Honda outpaced the broader market, growing 108%.
What models are driving that?
They highlighted specific models like the new Freed minivan, the Vizel compact SUV, and the Stepwagon. But the most intriguing mention in the transcript was regarding the Super One EV.
Oh, I found the commentary on the Super One fascinating. Management specifically called out that it was popular because it features a boost mode and feels very Honda-like.
Right. They're trying to inject their traditional brand identity, that sporty, responsive engineering, into an electric platform.
But the context Kawaguchi provided during the Q&A is crucial here. He noted that the overall EV market penetration in Japan is incredibly tiny. It's sitting at roughly 2%.
Only 2%. The Japanese market presents a really unique set of challenges for EV adoption.
Like what?
Well, you have severe space constraints in urban areas, making home charging installations near impossible for millions of residents who park in automated stacked garages.
Ah, right. You can't just plug in a charger in a robot garage.
Exactly. You also have a highly reliable grid, but one that is resource constrained. And perhaps most importantly, Japanese consumers are already accustomed to incredibly high fuel efficiency from domestic hybrids.
That makes total sense.
The overall Chinese market for internal combustion engine and hybrid vehicles contracted by 40% in the first quarter.
40%?
Yes. Almost half the market for the types of cars Honda build simply vanished.
That is terrifying.
Consequently, Honda's retail units in China plummeted 50% year over year. They sold just over 80,000 units for the entire quarter in what was supposed to be their critical growth engine.
Wow.
They originally projected selling 480,000 units for the year, and they are massively, perhaps unrecoverably, behind schedule.
A 50% drop in retail volume in your largest potential market is not a cyclical downturn. That is a structural collapse. Why is the bottom falling out so aggressively for Honda in China?
It is driven by a hyper-accelerated shift in both consumer preference and underlying technology. Chinese consumers are basically bypassing traditional legacy vehicles and rapidly adopting new energy vehicles, or NEVs.
Okay, but the critical nuance and the reason Honda is struggling so badly is that it's not just about swapping the gas tank for a battery, right? It's about software-defined vehicles, or SDVs. We hear the term software-defined vehicle thrown around a lot. Let's ground this in a real metaphor for you listening. The transition happening in China right now is not like upgrading from a V6 engine to a V8.
No, not at all.
It is exactly like the shift from a Motorola flip phone to the first iPhone. For decades, Honda has been selling the automotive equivalent of the perfect flip phone. It's reliable, the battery lasts forever, the call quality is great, and the buttons feel perfect.
Yep, the perfect machine.
But suddenly, domestic Chinese automakers like BYD and NIO introduce the smartphone. Chinese consumers don't care about the perfect mechanical buttons anymore. They care about the App Store ecosystem.
Right, the digital experience.
They care about LiDAR-integrated autonomous driving, in-cabin entertainment systems integrated with WeChat, and over-the-air updates that change the car's performance overnight.
Exactly.
So Honda is sitting there trying to sell a beautifully engineered mechanical machine, but the market only wants a rolling supercomputer.
That is an incredibly accurate characterization of the capability gap. Kawuchi explained that these SDVs and advanced digital technologies are developing at a breakneck pace driven by local Chinese competitors.
Because they don't operate like legacy automakers, do they?
No, they don't. These domestic automakers have completely bypassed the traditional siloed supply chain model. Instead, they are commonizing parts with local technology suppliers in Shenzhen and rapidly iterating on software.
Which gives them a massive advantage.
Huge. It drastically lowers their development costs, makes them hyper-competitive on price, and allows them to deliver the digital features that Chinese consumers now view as baseline requirements. A great gas engine simply does not compute in that ecosystem anymore.
And the financial reality of this technological mismatch is brutal. Honda used to have a production capacity of 1.5 million internal combustion cars in China, but according to the transcript, they had to execute a drastic and speedy adjustment. They worked with their local joint venture partners to physically shut down production lines, reducing their ICE and hybrid capacity to just over 700,000 units.
They literally took a chainsaw to their manufacturing footprint, cutting their capacity in half.
The level of capital destruction involved in shuttering plants of that scale is immense, and it causes massive secondary effects, specifically panic on the ground among the people actually trying to sell the cars.
Oh, dealer panic is very real.
Let's talk about that, because during the Q&A segment of the call, a reporter from the Asahi Shimbun asked a very pointed question about a recent corporate maneuver. Honda had to prematurely extend its joint venture agreement with its state-owned Chinese partner, GAC.
Right, and the original contract was not set to expire until 2028.
So why would they rush to extend it 4 years early while their sales are collapsing?
This is where you see the psychology of the dealership network breaking down. Kawaguchi essentially admitted that Chinese dealers and customers were looking at Honda's free-falling sales, looking at the factory closures, and thinking, Honda is going to abandon the Chinese market in 2028 when this contract ends.
Think about the mechanics of buying a car. If you are a consumer, you are absolutely not going to buy a Honda today if you believe the brand will vanish in 3 years.
Exactly. It would leave you with an orphan vehicle with zero resale value and no spare parts.
Furthermore, if you own a Honda dealership in Guangzhou, you are not going to invest capital into renovating your showroom or hiring technicians if you think the manufacturer is pulling the plug.
Exactly. The premature extension of the GAC joint venture was a desperate signaling mechanism.
Right, to say, hey, we aren't leaving.
Yes, Honda had to rush this out to stop the bleeding of confidence. They are trying to signal to the market, we are staying, we are committed, and we are working on a recovery strategy.
So they are essentially trying to buy enough time to revamp their local supply chain and develop a competitive SDV platform before the dealership network completely collapses.
Exactly. But buying time in the Chinese market right now is incredibly expensive.
Which brings us to how management is attempting to navigate this storm. We know what worked yesterday, relying on ICE vehicles in Asia, is failing today. So what is the plan for tomorrow? Let's move to management's guidance for the rest of the fiscal year and the massive operational headwinds they are facing.
The forward guidance provided by management is where the financial narrative gets highly complex. They revised their full-year operating profit guidance upward by JPY 150 billion.
Okay, upward.
The new target for the year is JPY 650 billion.
Right. And on the surface, Wall Street algorithms see a raised guide and automatically trigger buy orders. But we have to look at the underlying assumptions here.
Definitely.
Let's find out a glaring, almost insulting contradiction for you listening. Management raised their profit guidance by JPY 150 billion, but they did not increase their volume forecast by a single unit.
Not one.
They still expect to sell the exact same 22.8 million motorcycles and 3.39 million autos they projected last quarter. How do you plan to make 150 billion more yen without selling a single extra product?
You do it through accounting adjustments.
Oh.
Yeah. The upward revision is entirely a currency mirage. When Honda issued their original guidance, they modeled their expected revenue using a relatively strong yen assumption.
And now,
observing the current macroeconomic environment, they have updated their currency assumption to JPY 155 per US dollar for the remainder of the fiscal year.
So they're openly betting that the weak yen will persist, continuing to artificially inflate the translated value of the vehicles they sell in the United States.
That is exactly what they are doing.
That is a highly leveraged speculative bet on macroeconomic currency stability. What happens if the Bank of Japan, facing domestic pressure over the rising cost of imported food and energy, decides to intervene aggressively in the currency markets and the yen strengthens back to 135 or 140?
Well, if the yen strengthens significantly, the JPY 150 billion guidance raise vanishes into thin air instantly.
Just poof.
Gone. During the call, management quantified this sensitivity. They stated that for every single yen the exchange rate moves against them, it strips JPY 10 billion to JPY 12 billion straight out of their operating profit.
Wow.
If the exchange rate moves from 155 down to 145, their entire guidance raise is wiped out, and they are potentially looking at a profit contraction. They are entirely at the mercy of the spread between U.S. and Japanese monetary policy.
Okay, so that covers the currency risk, but now we have to address the absolute elephant in the room. This is the issue we touched on earlier regarding the adjusted operating profit, but we need to unpack the actual mechanics of the cash burn here.
The EV losses.
Yes. Management forecasted JPY 520 billion in EV-related losses for the full year, over half a trillion yen. We need to be very clear with the listener about what this money is actually being spent on. This isn't just a massive research and development budget for next-generation batteries, is it?
No. The reality is much more painful. This JPY 520 billion is predominantly a massive penalty fee.
Explain that.
To understand why, you have to look back at Honda's strategic shifts. Back in March, Honda radically altered its North American electric vehicle strategy.
Yep.
They had previous deeply entrenched plans that likely involved specific vehicle architectures, designated production timelines, and committed volume targets. Based on those plans, they signed binding contracts with a vast network of Tier 1 and Tier 2 suppliers across North America.
Right.
Suddenly, Honda decided that strategy was flawed. Perhaps the market demand wasn't there, the technology wasn't competitive, and they canceled or severely altered those plans.
Let's explain the mechanics of automotive supply chain contracts, because you can't just hit cancel on an order for car parts like you do on Amazon.
Exactly.
If Honda goes to a major supplier, let's say Magna International or battery enclosure manufacturer, and says, we need you to build 500,000 battery trays for our 2026 EV, that supplier doesn't just pull them off a shelf in the back room.
No, they have to build capacity.
Right. That supplier has to acquire real estate, build a new factory line, purchase massive aluminum stamping presses, secure long-term raw material contracts for the metal, and hire hundreds of unionized workers. They expend massive capital up front based on Honda's guarantee of volume.
Exactly.
When Honda suddenly says, never mind, we are delaying the program or changing the design, the supplier is left holding the bag on millions of dollars of stranded assets.
Yeah.
The contract legally dictates that Honda must make them whole.
The industry term for this involves tooling costs and take-or-pay contracts. Kawaguchi explicitly explained that the vast majority of this JPY 520 billion loss is direct compensation being paid to these North American suppliers to cover those stranded investments.
So they're literally just paying for nothing.
Yeah, Honda is currently locked in intense line-by-line negotiations with dozens of suppliers. They are haggling over the depreciation value of custom stamping dies and the cancellation fees for raw aluminum contracts.
Unbelievable.
This is precisely why none of this JPY 520 billion loss was actually booked in Q1. They literally do not know the final bill yet because the lawyers and accountants are still fighting over the exact penalty amounts.
And what makes this situation truly agonizing for Honda is the currency dynamic we just discussed. The forecast for this penalty actually went up during the quarter, increasing from JPY 500 billion to JPY 520 billion. Why did it increase? Because of the weak yen. Since Honda canceled contracts with North American suppliers, they have to pay these penalties in US dollars.
It's a vicious cycle.
The weak yen means Honda has to spend significantly more of its domestic currency just to buy the dollars required to pay the cancellation fees. It is a brutal double-edged sword.
It really is. The weak yen artificially boosts their U.S. sales revenue on paper, but it absolutely crushes their cash flow when they have to pay $500 billion yen in supplier payouts.
It perfectly illustrates the messy, cash-incinerating reality of attempting to pivot a massive, deeply integrated manufacturing operation midstream.
Yeah, and speaking of the fragility of manufacturing operations, we have to look at the supply chain wildcards that hit Honda immediately after the first quarter ended.
Yes, the Kumamoto earthquake. This struck on July 28th. What was the operational impact on Honda's network?
So Kumamoto is the geographical center for Honda's primary domestic motorcycle production. The initial earthquake was severe enough to trigger the plant's automated sprinkler systems, which extensively soaked the facility's interior and equipment.
Ouch.
Yeah. Honda was forced to completely suspend motorcycle production at that facility for 9 days to assess the damage, dry out the robotics, and recalibrate the assembly lines. But the more systemic issue was not the damage to Honda's own plant. It was the damage to their surrounding supplier ecosystem.
This exposes the dark side of just-in-time manufacturing. Automakers keep almost zero inventory on hand to save capital, right?
It's very lean.
Parts arrive at the factory dock literally hours before they are bolted onto a car. It is incredibly efficient until a natural disaster proves that if one single highly specialized link breaks, the entire multi-billion-dollar chain snaps immediately.
That is precisely what happened here. A major Tier 1 supplier named Astemo, which manufactures critical, highly calibrated components like suspension dampers, had a facility located dangerously close to the earthquake's epicenter.
And they went down.
Because Astemo's production lines went down, they could not deliver dampers to Honda. You cannot finish building a car without a suspension system.
Obviously.
Consequently, the disruption at this single supplier forced Honda to enact multi-day production suspensions at both their massive Saitama and Suzuka automobile assembly plants.
During the Q&A portion of the earnings call, a reporter pressed CFO Kawaguchi on what these plant closures mean for their ability to hit their annual unit sales targets. His response was startlingly blunt.
It was unusually candid for a Japanese corporate executive, I'll say that. He stated, "To be very honest, we don't know how much impact it will have on our unit sales at this point in time."
Wow. When the chief financial officer of one of the world's largest multinational manufacturers admits on public record that they honestly do not know the aggregate impact of a factory shutdown on their annual output, it tells you that the situation on the factory floor is incredibly fluid, highly unstable, and entirely outside of their immediate control.
That is exactly the type of unquantifiable uncertainty that institutional investors absolutely despise.
Oh, for sure. And the supply chain headaches do not stop at tectonic activity either. Management also flags significant structural cost pressures building in the background. They mentioned maintaining conservative estimates for raw material costs due to ongoing uncertainty in the Middle East, potentially spiking logistics and energy prices. But the most fascinating cost pressure to me was regarding semiconductors.
The semiconductor discussion is vital. The general public tends to think of the automotive semiconductor shortage as a pandemic-era anomaly that has largely been resolved.
Right, like that's old news.
But the nature of the shortage is evolving. Honda revealed they have factored in an additional JPY 20 billion to JPY 30 billion in cost just for semiconductor procurement for this current fiscal year.
Our reporter from Nikkei Automotive brought up a phenomenal point during the call. They asked about the competition for DRAM and NAND memory chips. We hear about the AI boom constantly, right? NVIDIA is printing money, data centers are consuming gigawatts of power, and tech giants are buying up every advanced chip Taiwan Semiconductor can produce. But how does the AI boom in Silicon Valley affect production of a Honda Civic in Ohio?
It comes down to the fundamental economics of semiconductor foundry capacity. A modern vehicle is not just an engine and wheels. It is a rolling network of dozens of electronic control units, or ECUs.
Explain what those do.
These ECUs manage everything from the advanced driver assistance systems like lane keep assist to engine timing to the infotainment display. The vast majority of these automotive systems do not require the cutting-edge 3-nanometer chips that power artificial intelligence models. Instead, they rely on what the industry calls legacy nodes, older, larger chip architectures like 28-nanometer or 40-nanometer chips.
Let me break down the manufacturing mechanics here. If you are TSMC or Global Foundries, you have a finite amount of cleanroom space and silicon wafer capacity, right?
Exactly.
Building a new chip fab costs upwards of $20 billion. Are you going to allocate your precious wafer capacity to building low-margin legacy 28-nanometer chips for Honda's windshield wiper controller? Or are you going to use that capacity to build ultra-high-margin 5-nanometer chips for NVIDIA's AI servers?
It's an easy choice for the foundries. They are prioritizing the massive profits of the AI sector, which means they're refusing to build new capacity for the legacy chips the auto industry desperately needs.
Because the foundries will not expand legacy capacity, the supply of these basic automotive memory chips is structurally constrained. When supply is constrained and demand from automakers remains steady, the price skyrockets.
Exactly. Honda is being forced to aggressively secure long-term supply agreements and pay massive premium markups just to ensure they have enough basic DRAM and NAND memory to finish building their cars.
That is where the extra JPY 20 to 30 billion in procurement costs comes from. It highlights how deeply interconnected and vulnerable the traditional automotive supply chain has become to the whims of the global technology sector.
That's a huge shift.
Okay, so let's synthesize all this defensive maneuvering. Honda is attempting to navigate a collapsing Chinese market, $500 billion in supplier cancellation penalties, earthquake-driven production shutdowns, and an escalating bidding war with the tech sector over legacy microchips. How are they structurally trying to survive this gauntlet?
They are relying on their war chest. They are leveraging that JPY 3.3 trillion cash pile to deploy strategic capital expenditures aimed at securing their long-term infrastructure.
Where is that money going?
Most notably, they're investing heavily in the acquisition of factory buildings and infrastructure for a massive joint battery manufacturing company with LG Energy Solutions in the United States.
Oh, wow. So they're essentially using the cash generated by selling hybrids today to physically build the factories required for the EV future they're currently paying so much money to delay.
Exactly. And perhaps more consequentially, they are actively seeking a lifeline from a historic rival. Management discussed exploring a crucial, potentially industry-altering partnership with Nissan.
Honda and Nissan teaming up, that's huge.
The potential Honda-Nissan collaboration is a clear admission of the sheer scale of the EV challenge. They are exploring joint development and standardization across software-defined vehicles, battery cell procurement, and shared underlying vehicle platforms.
Because Honda recognizes that developing a proprietary world-class software operating system and a bespoke EV architecture from scratch is simply too capital-intensive and too slow.
Exactly, especially while they are hemorrhaging market share to hyper-agile competitors in China. By teaming up with Nissan, they hope to combine their legacy manufacturing volume to achieve the massive economies of scale required to survive the transition.
Which brings us perfectly to the bottom line. We have examined the record hybrid profits generating cash today, fighting against the massive EV transition costs and structural headwinds of tomorrow. We need to translate all of this data into a definitive, actionable stance for you, listener. What does this earnings report actually mean for someone managing a portfolio?
We have to segment the conclusion based on your investment horizon.
Okay, let's start short term.
The short-term operational signal is undeniably bullish. The velocity of their cash flow generation is phenomenal right now. Their absolute dominance in the North American hybrid market provides them with a highly reliable, high-margin revenue engine that is perfectly tailored to current consumer sentiment.
So if you are looking at the next 2 to 4 quarters, the core legacy business is functioning at an elite level.
Yes. However, the long-term strategic signal requires intense caution. The structural collapse of their market share in China, which shows no signs of reversing, combined with the astronomical, unquantified costs of their ongoing EV pivot in North America, creates a very perilous, highly volatile path forward over the next 5 years.
Let's break this down into specific, actionable takeaways. First, if you are a listener holding this stock primarily for income, what is the play here?
If you are an income or dividend investor, Honda remains a solid hold. Despite the chaos of the EV transition, Honda maintained its dividend guidance at JPY 70 per share for the annual dividend.
That's reassuring.
More importantly, management explicitly stated they are targeting a 3% dividend on equity, or DOE, ratio.
Let's explain why that metric matters, because most investors look at the dividend payout ratio, which is the percentage of net income paid out as dividends. But automotive earnings are notoriously cyclical. They boom and bust with the economy. If earnings crash, a high payout ratio means the dividend gets cut. Dividend on equity, however, measures the dividend against the total shareholder equity, the book value of the company.
Exactly. Because Honda has JPY 3.3 trillion in net cash, their equity base is massive and highly stable. By targeting a DOE ratio, they're essentially signaling that even if operating profits fluctuate wildly due to currency or supply chain shocks, they have the war chest to maintain the dividend payout from their balance sheet.
That dividend is exceptionally safe.
Yes, it is.
Okay, but what if you are a listener looking for capital appreciation? What if you are scanning the market for the next massive growth story in the electric vehicle space?
If you are looking for explosive EV growth, you must adjust your expectations immediately. Do not allocate capital to Honda under the delusion that it is an agile, pure-play EV growth stock poised to capture market share from Tesla or BYD. That is fundamentally not what this company is right now.
Right.
When you buy Honda today, you are investing in a highly optimized, immensely profitable motorcycle and hybrid cash cow. And you must accept that this cash cow is currently being forced to use its billions in operational profit to pay the painful, messy tuition, meaning that JPY $520 billion in supplier cancellation payouts, just to buy enough time to catch up in an electric vehicle race they are currently losing.
I think that is the most accurate framing possible for this stock. If I asked you to synthesize the entire complex state of Honda as an investment vehicle into one definitive sentence, how would you describe it?
I would define Honda as a highly profitable hybrid fortress that is desperately buying time to fund a dangerously expensive electric future.
A highly profitable hybrid fortress desperately buying time to fund a dangerously expensive electric future. That captures the exact tension in this Q1 earnings report perfectly. Which brings us to a final, provocative thought for you to mull over as you analyze the broader automotive sector. We discussed Honda's exploratory collaboration with Nissan to develop software-defined vehicles and share EV platforms.
Yes, we did. And the industry consensus is rapidly converging on the reality that future vehicles will essentially function as smartphones on wheels.
Yeah.
The competitive moat will no longer be the mechanical engineering of the chassis or the combustion efficiency of the engine. The primary selling point will be the underlying software architecture, the digital ecosystem, and the seamless integration of autonomous features.
Exactly, as we are already witnessing in the Chinese market.
Exactly.
So here's the question you need to ask yourself if you are investing in legacy auto. Will combining the massive traditional manufacturing volume and mechanical engineering heritage of two legacy Japanese automakers, Honda and Nissan, actually be enough to build a software ecosystem capable of competing with pure-play, software-first EV giants who don't have to worry about legacy internal combustion supply chains?
That is a great question.
Or is this proposed partnership simply two wounded legacy giants leaning against each other in the dark, hoping the combined weight keeps them from falling over?
That is the multi-trillion-dollar question that will define the survival of the legacy automotive industry over the next decade.
It truly is. Keep a very close eye on the supply chain updates emerging from the Kumamoto region over the next few weeks, as the final assessment of the Astemo damper shortage will heavily impact their Q2 production numbers. Thank you for joining us for this deep dive, and we will see you next time.